Western economists predicted Iran's collapse by 2013. The currency would crash, banks would fail, hyperinflation would destroy the nation's economy. None of it happened, not in the way they forecasted. Instead, Iran's economy contracted 6.8% in 2012, stabilized by 2015, and adapted to sanctions that most thought would trigger immediate systemic failure. The nation survived what would have destroyed lesser economies because it implemented strategies that directly contradict Western economic doctrine. The wealthy built escape routes, the government restructured production, the population shifted to barter and informal networks. The sanctions regime began incrementally but accelerated dramatically after 2010. International powers targeted the nation's oil exports, banking system, and access to international trade. By 2012, oil exports had declined from 2.5 million barrels per day to 1 million. This was not a minor economic adjustment. Oil revenue represented approximately 80% of foreign exchange earnings. The rial plummeted 40% against the dollar between 2011 and 2012. Inflation reached 34% by 2013. The central bank's foreign exchange reserves diminished rapidly. Unemployment climbed past 12% officially, likely higher in reality. This created the conditions that typically precede economic collapse. When a nation loses 60% of its primary export revenue within 2 years, historical precedent suggests systemic failure follows. Argentina experienced this in 2001. Venezuela faced it in the 2010s. Yet the nation's government possessed advantages these nations lacked. First, it maintained a large manufacturing base independent of oil revenues. Petrochemicals, agriculture, automotive production, and textiles all existed at meaningful scale. Second, the nation had decades of experience operating under partial isolation. Sanctions were not new, they were intensified versions of existing conditions. Third, leadership implemented unorthodox but effective economic restructuring. The government encouraged alternative trade partnerships with China, India, and Russia. These strategies violated conventional economic theory but proved pragmatic. The period from 2012 to 2016 represented the nation's true economic crucible. Daily life transformed. The middle class experienced purchasing power erosion at rates rarely documented in peacetime. An engineer earning a salary of 10 million reals monthly could purchase approximately $5,000 worth of goods in 2011. By 2013, that same salary purchased approximately $1,500 worth of goods. This was not merely inflation. This was the systematic destruction of stored wealth. Savings evaporated. Pensions became worthless. Families that had accumulated resources over decades watched those resources dissolve in months. Professionals faced documented unemployment. Doctors faced licensing restrictions. Engineers migrated to construction labor. Architects became teachers. This pattern, overqualified workers accepting menial positions, appeared universally across collapsing economies. Housing markets collapsed. Property values declined 50% in major cities between 2011 and 2015. Yet oddly, real estate maintained intrinsic value. A house remained shelter. A building provided security. This distinction matters profoundly. In Weimar Germany during 1923 to 1924, hyperinflation destroyed currency. But real property ownership provided anchor value. Families that owned homes survived. Families that held savings in paper money did not. Venezuela's experience offered a more recent parallel. When oil revenues disappeared after 2015, Venezuela's economy contracted 73% cumulatively between 2013 and 2020. The wealthy transferred capital to Miami and Panama months before the collapse accelerated. The middle class lost everything in peso devaluation. The poor faced starvation. But professionals who owned property, who possessed gold, or who had converted wealth into hard assets 6 months earlier, retained options when others had none. Argentina's 2001 collapse demonstrated another variation. Banking system freeze meant citizens could not access savings. The corralito, the restriction on bank withdrawals, lasted months. During this period, cash in hand became more valuable than bank deposits. Formal currency lost acceptance. Communities that had established barter networks survived. Neighborhoods organized to trade services and goods outside the formal economy. The sanctioned nation's crisis proceeded differently because its government acted systematically to prevent banking system collapse. Rather than allow banks to fail, leadership maintained currency controls and prevented the bank runs that had destroyed other nations. Was this economically efficient? No. Did it preserve social stability? Yes, the distinction is crucial. Sound economic policy and economic survival are not identical. The formal economy contracted, but the informal economy expanded massively. By 2014, estimates suggested informal economic activity represented 30 to 40% of total economic output. In formal terms, the economy was collapsing. In practical terms, people were adapting. Ordinary citizens made decisions that the wealthy had made months earlier. Gold purchases increased. The price of gold in reals doubled between 2012 and 2013, as citizens converted devaluing currency into non-perishable value storage. Land purchases accelerated despite price declines because land provided intrinsic utility. Food stockpiling became common. Families purchased grain, rice, sugar, and dried goods ahead of anticipated price increases. Business owners shifted from rial-denominated contracts to dollar-denominated arrangements, even when violating government policy technically. The government enforced price controls on essential goods: bread, rice, fuel. These price controls did not prevent shortages. They did prevent price spirals that might have created panic. Citizens that had queued for 12 hours to buy bread in 1979 during the revolution possessed institutional memory of economic collapse. What actually survived the economic collapse? Not the rial, not the stock market, not bank savings held in nominal terms. What survived? Tangible assets with intrinsic value. Gold and silver purchased before and during early phases of devaluation retained relative value. Property purchased at prices of 50 million per square meter in 2010 sold at prices of 100 million per square meter in 2015. The currency price doubled. The dollar value remained stable. For a holder, this meant zero gain. But it meant no catastrophic loss. Citizens who owned businesses, particularly those producing goods for domestic consumption rather than export, adapted. A textile factory that exported to Europe faced crushing sanctions. That same factory converting production to domestic consumption faced declining access to imported raw materials but maintained domestic market access. Wealthy citizens who converted local currency savings into physical dollar currency between 2011 and 2012, before the black market exchange rates deteriorated further, maintained purchasing power. This strategy required recognizing the collapse before it accelerated. Citizens with medical training, engineering expertise, and language skills, particularly English, maintained income-generating capacity despite economic collapse. An English teacher unable to maintain full practices retained option value in their credentials for future recovery or emigration. Citizens with family connections to business networks, religious institutions, and political structures accessed resources unavailable to isolated individuals. A family connected to bazaar merchants accessed goods before prices climbed. Contrast this against what failed. Savings denominated in local currency became worthless. Bonds issued by the government became questionable. Stock market holdings collapsed. Pension obligations faced potential default. Formal sector employment offered no security. The question facing observers today concerns the transferability of these patterns. Do survival mechanisms apply elsewhere? Evidence suggests yes. First, the pattern of currency devaluation preceding economic collapse appears universal across multiple nations and time periods. When a nation's currency loses 50% of value in 2 years, economic contraction follows. This is not unique. It is structural. The mechanism is mathematical. If wages remain static while currency values decline, purchasing power deteriorates. Second, the pattern of informal economic expansion during formal sector contraction appears universal. When formal systems break, informal systems expand. During Argentina's crisis, barter clubs emerged. During Venezuela's contraction, informal trade networks replaced legitimate commerce. Third, tangible assets consistently outperform financial instruments in collapse scenarios. This holds across geographies and time periods. During Weimar's hyperinflation, land retained value while currency became worthless. During the Soviet Union's collapse, individuals who owned productive capacity or tangible goods preserved wealth. Today, several signs echo pre-crisis indicators. Geopolitical tensions create trade restrictions. Currency values fluctuate more dramatically than in previous decades. Central banks debate unprecedented policy interventions. Debt levels reach historically elevated percentages. This does not mean collapse is inevitable. The sanctioned nation's economy contracted significantly, but did not collapse into state failure. It stabilized and adapted. Recovery occurred when sanctions eased, but the period of contraction imposed genuine hardship. Understanding how the nation survived that period offers insights for preparation, without advocating panic. The practical implications are straightforward. Diversification beyond paper assets, ownership of productive capacity, maintenance of dollar reserves, development of alternative trade relationships and social networks. The core finding is unmistakable. The sanctioned nation's economic collapse did not follow the trajectory that Western economists predicted. The nation survived through government policy prioritizing social stability over economic orthodoxy, widespread asset diversification before crisis acceleration, and informal economic network expansion. History demonstrates that economic collapse is not the sudden catastrophic event that popular media portrays. It is a gradual process with observable patterns and indicators. Currency devaluation precedes it. Informal economy expansion accompanies it. Tangible asset ownership provides resilience through it. Nations that understand these patterns prepare before necessity forces adaptation. Those that do not prepare face the consequences of reactive adjustment when options narrow. For viewers seeking this deeper understanding, subscription to this channel ensures regular analysis of historical economic mechanisms and their modern applications. History has already answered the questions facing economies today. The answers require only careful examination of what actually occurred rather than what economists believed would occur. History has the answers. The channel shows where to look.